This is Saul and the Sissy. It is Monday, February 8th. This is Best Cash Cow's weekly rate update, where we cover what's going on with savings rates, CD rates, and more. The name of the game this week, as it's been for the past 52 weeks and longer, has been the continual decline in rates that banks are offering. So let's go and take a look at what's happening according to the averages of the Best Cash Cow rate tables. Savings rates dropped by 1 basis point, from 1.47% APY to 1.46% APY. One-year CDs declined by 3 basis points to 1.82% APY. Three-year CDs dropped by 2 basis points to 2.61% APY. And 5-year CDs actually broke the trend and rose by 9 basis points to 3.29% APY. And that's the second week that we've seen 5-year CD rates go up. It actually brings up an interesting point, and that is what we've seen is the spread between 5-year CDs or longer term CDs and shorter duration deposit accounts like savings accounts, money market accounts, as well as 1-year CDs and 2-year CDs. We've seen that spread increase. So longer term accounts are earning more, shorter term accounts are staying steady, shorter term accounts are on a downward slope, and the spread as a result is increasing. So if you go to our website, bestcashcow.com, and you look at the most recent article that I wrote, you'll actually see a graph which shows you what I'm talking about there. And the question is, at what point does that spread become so big that it becomes worthwhile to think about or consider investing or putting some money into a longer term CD versus keeping your money totally liquid in a savings or money market, or even just investing in a 6-month or a 1-year CD. It's something that we're going to be analyzing more, and I hope to have more information next week. But if we just take a step back and look what's happening on the rate environment, it seems that rates aren't going to be going up anytime soon. The Fed Funds Futures Prediction Chart, which is put out by the Cleveland Fed, shows that rates will stay between 0 and 25 basis points, or rather the Fed Funds rate, which anchors bank rates, will stay between 0 and 25 basis points at least through June 2010 and probably into 2011. At least that's what most analysts are saying. The economy, while sputtering along, doesn't seem to be picking up that much momentum. Employment is still lagging. There's high unemployment, although we came down below 10%. We're still losing jobs. There's still been no net gain of jobs, and it's hard to see that picking up over the next year. So it's very possible that we'll be in a low rate environment at least for another year, or potentially for another year, and perhaps even longer. And if you take a look at a country like Japan, which has been in a low rate environment for the past 10 years, actually the past 20 years, then it's very possible that investing in a longer term CD, something longer than 6 months or a year, may not be a bad thing to do to get that extra yield. The yield difference between a 1-year CD and a 5-year CD is 1.5% right now. So certainly if you're building a CD ladder, going out a little bit longer may not be a bad thing. And I think as we get more data, we'll start to understand, or get a better understanding of what's going to happen to those longer term rates. But certainly what we've seen and what we continue to see is stability in longer term rates and even slight upticks, while shorter term rates continue to fall. I would like to ask that if anybody has specific questions they'd like me to answer, feel free to come onto our website, bestcashcow.com, and leave me a question, and I'll look through them and provide some answers on our next show. So until next week, thank you very much. This is Saul and the Sissy signing out. Have a good week and happy investing.